On quite a serious note, here we are again, and you and I are talking, and along with Anna, about the same issue. And yet I look at volatility, Mark, it's repressed. I look at, global economic uncertainty, it's dropping. Mark, does it shift the dial at all for you?
Well, I think that these economic sanctions, which you highlighted, it's not just the rhetoric in the UN, are starting to take a little bit of a bite. And should they continue along the lines that they bite North Korea and China and the U.S. don't get into their own kind of fight over this, then I think it's relatively contained for global markets, in part because it is so hard for global markets to kind of price in a more existential threat of a nuclear war.
Yes, indeed. It's very difficult to price. What is your stance on the yen as we continue to see the nature of this geopolitical threat unfold, Mark? Obviously, the yen typically a safe haven, but proximity to potential crisis, does that change things this time?
Well, this is fascinating. And of course, we have many clients around the world who want to know about safe havens. And I think the yen is such a great example of how not everything is a safe haven for every crisis. And of course, when you get these risk-off moves, people are kind of net short the yen. And so you see that buying. But we see that moderating out over a short period of time as those trades normalize. Because, of course, if the Asia is the center of a crisis, we don't think that the yen would be that kind of safe haven over a period of months or something like that.
Mark, I'm looking at your freshly printed monthly letter. Ever the stoic global CIO, and I quite like it. You still see the upside for equities, and we don't believe it currently makes sense to sacrifice returns to buy tactical hedges. And that's a theme that you have said to me consistently when we met in Davos, when you last sat down with me here. So you don't think that we're reaching a pause or a tiredness in these markets?
Well, I think you're right that we've been consistent in saying stay overweight global equities, and we still are, and that the attempt to achieve kind of a tactical hedge by picking up the newspaper and getting short around something like the rhetoric we've seen, that strategy has not worked, and we don't think it's going to work going forward. But that said, we have just taken down slightly our global equity overweight to reflect a couple of things. One is that valuations for equities they're up about 14% for global equities. That's about double what we would expect for the year. So we've had a good run with this overweight. And then I think, we are at kind of a historic moment around the Fed where the Federal Reserve has said they're going to start shrinking their balance sheet. They indicated they're still on track for another rate hike this year. And yet at the same time, they said, yes, inflation, it's not where we expect. That's kind of a mystery to us. But we're going to kind of maintain the rate path that we described. So those factors made us think, maybe it's a time to take a little bit off and see if we get a pullback around some of these factors, and then we can go back in.
Yeah, Mark, I wanted to ask you about that. As we see the Fed start to or set a course for unwinding its balance sheet, you've pulled back a little bit, I understand, but not suggesting that stock markets look incredibly vulnerable, perhaps, right now. If they don't look very vulnerable, why not? Given the run-up that we saw during the quantitative easing periods, as we move to quantitative tightening, why are more people not talking about the vulnerability of stocks?
Well, I think it comes back to several factors. First, just because the Fed is pulling away some of their support, the ECB and the Bank of Japan continue to provide that stimulus into markets. Secondly, we do have this global synchronized growth at this point where something like 45 countries that the OECD monitors are growing at this time. And we still get earnings growth, and that ultimately is what drives stocks. So in a low interest rate world, the valuations are not so excessive, the leverage is not so high that we see an unsustainable situation at the moment.